Good morning. I think you're well, even though you have some issues. You may have some issues in the country. I hope so. You're fine. And before starting the presentation of this class, I just, as usual, it is I feel it's my duty to remind you all that if you all have any questions or any other clarifications or comments, you can unmute your microphones and directly tell me, or otherwise you can use the chat box, and through the chat box you can type the or just inform me or tell me the your questions or any comments or clarifications. That is the arrangement we are having to interact ourselves. So having that note, I like to move to the today's class topics. Actually, you all may remember that the last week we have discussed about the financial reporting and analysis part. And I have explained you all that the financial reporting and who are the stakeholders using the financial reporting and disclosure requirement and all. Then when we are starting, when we were discussing the analysis or financial analysis section, we stopped the class at that point. And so I'm going to continue the some slides, very few slides from the last class, which is related to the financial analysis section. And then I will continue the today's one. Today we are going to discuss about the internal and external audit section. So this financial performance analysis, this section we have started last class, and first we have seen about the components of the financial performance, and then I have mentioned you that financial position we are checking. What is the financial position? Which statement showing the financial position? It is the balance sheet. The balance sheet showing the financial position to us, and then financial performance, of course, through the P&L we can get to know about the financial performance and cash flow and equities, of course. So these are the components of the financial performance, and then we discuss something about the different accounting techniques to do the analysis, ratio analysis, trend analysis, and comparison with the strategies and tactics and peers with the industries. And then we have discussed something about the statistical techniques. So I have explained you about the statistical techniques, and in the statistical techniques, indices and other indicators we are calculating. So after that, we have discussed about the objective of the performance analysis and what are the purposes, and then for the strategic planning and to identify the areas to be improved, to identify the different type of unidentified risk and all sort of things we have discussed in the last class. Actually, this is the slide exactly I stopped in the last class, the ratio on asset quality. And in the ratio on asset quality, we have checked the gross NPL ratio, and gross NPL ratio, then net NPL ratio, provision coverage ratio, impaired asset ratio, and concentration ratio. Up to this point, we have studied and we have stopped at this point. So do you all have any questions on that? Can somebody give the feedback whether you all are listening my presentation through the chat box? Can somebody confirm me? Okay, there are feedbacks. So if you all have any questions, I can answer. Otherwise, what I can do is I can continue from these slides. Okay, since there is no questions, I'll move to the ratio on profitability and earnings. This is actually, I have explained you all the last class that when we are calculating the ratios, we are calculating 4 main ratios. The first one is asset quality, which asset quality is in the banking sector and finance company sector. Normally, we are giving asset quality of the loans and advances and all. Then after the asset quality, the profitability is one of the most important ratio analysis, because this profitability is for the two purposes. The profitability analysis is most important. The first one is the investors will have keen on these profitability ratios, because their main purpose of investing in this company is getting the profit. So in that cases, the profitability analysis is most important. And other than that, this the profitability will generate internal capital to the institution. So profitability, the ability of the making profitability will show that the company's sustainability. If they have the more profit, and if they keep that profit as a return profit, that will create internal capital to the banks and finance companies. So the first ratio of the profitability is return on assets. This ratio showing that, okay, what is the ability of the assets to create the return. Then we are calculating this return on asset ratio based on the profit before or after tax divided by the total assets. And actually, profit before tax, we are calculating profit before tax as well as interest. So PBIT, we are taking the normally PBIT, profit before income, profit before interest and tax divided by the total assets, multiply by the 100. So that is one of the way. This is before tax ROA. Sometimes we are calculating after tax ROA as well. In the after tax ROA, we are calculating profit after tax divided by the total assets and multiply by the 100. If you all see the bank annual reports, the banks normally calculating the ROA and ROA before profit as well as after profit. So this ratio showing that, okay, if we have the 100 million of assets, what would be our ratio? What would be our return? So it is calculated based on the percentage wise, the ability. So it is easy to compare the profit of the company X or bank X with the bank Y, because if it is the bank, sometimes the bank X and banks Y may be different sizes, different natures, or business models are different. But then we can't easily compare the bank X and bank Y based on the absolute value of the return or absolute value of the profit. So for that purpose, we are calculating the percentage wise. Okay, based on the total assets of the bank, what would be the return? So that is the ROA. And then we are calculating the ROE, return on equity. And return on equity, of course, this is what is the return attributable to the equity holders. So then we are deducting everything from the profit, everything in the sense up to the tax level. So the profit after tax divided by the total equity multiplied by the 100. That is the way we are calculating the equity. So ROE, particularly the shareholders and investors are very keen on the ROE, because that is the amount or that is the percentage showing to the investors, okay, this is the percentage of return you are getting for your investment or equity investment. So in that case, ROA and ROE ROE showing the return attributable to the equity holders. Just for more clarifications, what would be the high ratio? No, generally the ROE must be the higher ratio compared to the ROA, because generally the assets may be higher than the equity, normally, generally. So in that case, the ROA, after profit ROA, after tax ROA will be less than the ROE, because in the ROA calculation, denominator assets, total asset value will be higher than the total equity value. So in that case, in that scenario, generally ROE will be higher amount than the ROA. So that is the two ratios. Then the efficiency ratio. Actually, the efficiency ratio and cost to income ratio and staff cost to operating ratios are showing the ability of the management or efficiency of the management. So efficiency ratio, we are calculating the operating cost divided by the interest income plus non-interest income, net interest income plus non-interest income. Generally, the total interest income, total income multiplied by the 100. So that is the way we are calculating the efficiency ratio. And then cost to income ratio, of course, total cost to total income multiplied by the 100. And staff cost to operating expenses, we are calculating total staff cost divided by the operating expenses multiplied by the 100. In Sri Lanka, generally the staff costs for the banking and finance company sectors, staff costs are very high. So in the recent years, it is nearly 50% of the total operating cost are represented by the staff cost. So in that way, you can calculate, okay, it will show that out of the total operating expenses, what is the staff cost? So whether staff cost is high, or we have to improve any efficiency of the workers by, or cut the workers salaries or something, we can take the decision based on this staff cost to operating expenses ratio. And the other one is, normally in the banking sector, we are using the net interest margin ratio. So the interest, we are calling as a interest margin ratio. This is we calculating net interest income divided by the total or average assets multiplied by the 100. What is the way of calculating average assets in the exam? If they give the opening assets and ending assets, what we can do is we can add the opening assets and ending asset, divide by the 2, then we can get the average assets. I think you will understand that how to get the average assets. The opening assets plus ending assets divide by the 2, then you can get the average assets. So for the interest margin, you can what we can do is net interest income divide by the average assets multiply by the 100. And then finally, we are calculating interest income to total income ratio. So interest income to total income ratio, what we are doing is interest income divide by the total income and multiply by the 100. So these are the way we are calculating ratios and profitability and earning. So you will have, if you will have any questions on these ratios and profitability, you can ask. Any questions? Okay. Then we will move to the ratio on solvency or capital ratios. If you will see that in the banking sector or finance company sector, this capital ratio is most important. In generally, when you are when you compare the, or when you take a production company or IT related company, this capital ratio is not that much important. But in a banking institution, the capital ratio is much important. Why? What is the reason? I think I have already explained you all these things. In the banking business, they are running with the depositors' money. So to absorb additional risk, the capital will be the cushion. And whenever the bank or finance company having the more capital, then the rating agencies and regulators are satisfied that, okay, this particular bank or particular finance company has the adequate absorbing power, risk absorbing power to meet any unexpected risk. So I have already told you, I think I remember that I have discussed you. There are two resources we are considering at two factors we are considering as a resource for a banking sector. One is capital. The capital is showing the solvency or some absorption power to against the unexpected risk. And liquidity, of course, also considered as a one of the the resources, because that is also will be function as a resource to absorb any risk arise from the liquidity of the banks or banking industry. So in that case, this ratio on the capital and solvency is most important. And first we are calculating the capital adequacy ratio, the tier 1 ratio. Actually, those who are working in the banks and finance companies, especially at the head office and the finance department, may have the idea about the tier 1 capital. Others actually may not have much idea. Actually, in the total capital of the bank can be divided into two sections. According to the Basel Accord or Basel Standard, the capital of the bank can be divided into two sections. One is tier 1 capital, other one is tier 2 capital. The tier 1 capital is generally considered as a high quality capital. And the tier 2 capital is not a high quality capital, it is sort of hybrid capital. The hybrid nature of the capitals are included in the tier 2 capital. So if I give an example for a tier 1 capital, in the bank balance sheet you can see paid up capital. It means the general capital amount, the paid up capital amount, which can be considered as a tier 1 capital. The second thing is the retained earnings. Retained earnings can be considered as a tier 1 capital. And I think revaluations gain, the revaluation reserves can be considered as a tier 1 capital. Likewise, there are some tier 1 capitals or high quality capital, which is called as a tier 1 capital. So when we are calculating the capital adequacy ratio, we are first considering what is the capital adequacy ratio of the tier 1 capital, or based on the tier 1 capital, what is the capital adequacy ratio. So we are calculating what we are doing is taking the tier 1 capital, divide by the risk weighted assets, multiply by the 100. So this is the capital adequacy ratio. I don't know whether you all want more explanation on the capital adequacy ratio and how it's computing, and how the banks are computing the capital adequacy ratio. Do you all want more explanation, or this is enough? If you all have the basic idea about the capital adequacy ratio, I need not to waste my time. Or if you all really need more explanation on the capital adequacy ratio, how they are calculating, why they are calculating capital adequacy ratio, what is the rationale behind for calculating capital adequacy ratio. If you all want those information, please let me know through the inbox. Then I can expand the explanation. Otherwise, if you all have some understanding about the capital adequacy ratio, or if you all already heard about the capital adequacy ratio, then I need not to waste my time just again explaining this. Or do you all wanted to explain more, or just it is enough? Okay, one of the two people asked me to sir, please explain the capital adequacy ratio. They have mentioned like that. So I just giving some more explanations. Actually, in the banking industry, based on the Basel Accord in the sense there's a Bank for International Settlement in the Switzerland. Based on that head office in the city called Basel. So the Bank for International Settlements time to time release some capital adequacy requirement or document. That document is called as a Basel document. So in 90s, they have later part of the 90s, they have released the first capital adequacy or capital requirement accord or the standards, which is called Basel I. And then subsequently, they have released other document called Basel II, which has more stringent than compared to the Basel I. And then in the, I think after 2009 crisis, they have, or 2008, that time they have come up with the Basel III. Actually, in Sri Lanka, now we are comply with the Basel III capital accord. So based on that capital requirement, the earlier we had a model that every bank must have the same amount of capital. It may be the bankers loan, the largest bank, or it may be Kagals Bank, the newly opened small bank. So whether there is no any differentiation, both has to have the similar amount of capital. That is the initial, the very traditional idea about the capital of the bank. Then the Basel Committee, the Bank for International Settlement, and that Basel Committee come up with an idea. It is not fair to ask same amount of capital between the largest bank or to the same amount of capital applied to the largest bank and a smallest bank or medium bank. Then what they have come up with, they came up with an idea that, okay, the capital requirements are decided based on the risk-weighted assets of the banks. So what they have done is, okay, they give different risk weights for the different assets. For example, if it is the credit, loans and advances, it has to be multiplied by the 150%. If it is the different rating customers, if it is the AAA customers, 20%, the AA customers, 50%. Likewise, there are different risk weights for the different loans and advances. If it is the cash balance, cash in hand, 0%. And if it is the treasury bonds and treasury bills, 20%. Likewise, different risk weights are given to different category of assets. Based on that calculation, they derive the risk-weighted capital or risk-weighted assets. Then they are giving the different assets, risk weight for the different assets. They derive the risk-weighted assets. So based on that risk-weighted assets, then they say that, okay, this much of capital you have to keep. For example, it is the largest bank or small banks, no, there's no matter. But if you have the risk-weighted assets of 100 million, you must have, if for example, if you take as a 10%, you must have 10 million as a capital. That is the total capital. I'm assuming that I don't apply the real weights and real rates. Just let's assume that if it is a 10% minimum capital adequacy ratio, what they have to do is, if there is a total risk-weighted assets is 100 million, they have to keep 10 million as a capital, total capital. Then what they have done is the tier 1 and tier 2 capital. They have divided the capital into tier 1 capital and tier 2 capital. If it is the tier 1 capital, which is the high quality capital, as I mentioned already, which should be paid up capital, and it can be return earnings, it can be revaluation reserve. Likewise, it's a high quality capital they call as a tier 1 capital, and they say that okay, you must keep 5% of the capital as a capital person. You have to maintain 5% as a tier 1 capital. In that scenario, if their risk weighted assets are 100 million, they have to keep 5 million as a tier 1 capital. And the total capital, the second ratio, it's showing that the capital adequacy ratio total, which is the 10%, then total capital to divide by the risk weighted asset multiplied by the 100. In the total capital, tier 2 total capital includes tier 1 capital and tier 2 capital. The tier 1 capital, it is a high quality capital, and tier 2 capital, of course, which is some hybrid nature of the capitals. It may be unsubordinated, 5 years or more, the debentures can be included as a tier 2 capital. The hybrid nature capital. It is a long-term the funding sources, but it is not really capital. So sort of hybrid nature, it can be included in the tier 2 capital, and the tier 1 capital and tier 2 capital include the both, comprising the both, mentioned as a total capital. So that is the total capital adequacy ratio, which is calculated based on the total capital divided by the risk weighted assets multiplied by the 100. I think now you all can understand the this why we are calculating capital adequacy ratio and what is the rationale behind it. And then we can move to the net NPL to capital ratio. What is the meaning of net NPL to capital ratio and why it is calculated? I have already mentioned that these asset loans and advances are main asset item for a bank or finance companies. So asset quality is most important for them. In that scenario, they are just calculating what is the NPL amount for a net NPL amount for a bank, and compared to the net NPL, what is the capital the particular bank or finance companies is having, and to compare whether the particular bank or finance companies has the enough absorbing power to meet any unexpected risk arise from the NPL ratios or NPLs. How do we calculate the net NPLs? I have explained you. How do we calculate the net NPLs? Can anybody, any volunteer inbox me just to confirm whether you have understand the last class? How to calculate? I said that a formula. How to calculate the NPL ratio, net NPL ratio. Any volunteers? The net NPL is calculated based on the gross NPL minus interest in suspense minus specific provisions. The net NPL is gross NPL minus interest in suspense minus, I think I have, last class also I have mentioned you all that gross NPL minus interest in suspense minus specific provision. Specific provision is called in the chat box. I have mentioned you all that gross NPL minus interest in suspense minus specific provision can be called as a net NPL. So what they are doing is net NPL divided by the total capital multiply by the 100 is called or they call as a net NPL to capital ratio. Why they are calculating net NPL to capital ratio? Just to see that whether the bank capital is adequate enough to meet any unexpected risk arise from the NPLs. Because in a bank or finance companies, the asset quality or the asset quality is most important factor or represent more highly representing in the balance sheet of the bank. Then we are calculating net NPL to capital ratio. Then we are the last item under the solvency capital ratio. We are calculating the solvency ratio. Actually, under the Basel III, I have already mentioned you all that. Now, what is the version of the Basel Accord? We are in Sri Lanka. We are implementing. We are already implemented Basel III. We are following the Basel III in Sri Lanka. So under the Basel III, this leverage ratio has been introduced, and which is they are calculating based on the tier 1 capital divided by the total exposure and multiply by the 100. So this is the way they are the ratios on the solvency and capital is calculated. If you have any doubt, you can ask. Otherwise, I can just move to the other section. Okay. Then the ratios on liquidity. I think we have discussed these liquid asset ratios in the risk management section as well. I have mentioned that the one of the mitigation factor for a liquidity risk is maintaining a stock or statutory maintaining the liquid stock or liquid asset stock is the one of the mitigation factor for a liquidity risk. So in order to ensure that the banks are maintaining the certain amount of liquid assets, the central bank introduced a ratio called statutory liquid asset ratio. Under the direction, it says that the banks must maintain 20% as a statutory liquid asset ratio. Under the statutory liquid asset ratio, how we calculate the statutory liquid asset ratio is the statutory liquid assets divided by the total liabilities or deposits multiplied by the 100. Why I have mentioned the liabilities and deposits here? Because if it is a licensed commercial banks, they have to calculate statutory liquid assets divided by the total liabilities multiplied by the 100. If it is a licensed specialized bank, what are the licensed specialized bank in Sri Lanka? NSB is a licensed specialized bank. The banks which cannot maintain current account is called licensed specialized bank. So if it is a licensed specialized bank, then the statutory liquid asset ratio is calculated by statutory liquid assets divided by the deposits multiplied by the 100. In that case, somebody may ask the question that what is the statutory liquid assets? What is the statutory liquid assets? Can anybody? Can anybody answer that? What are the assets included in the statutory liquid assets? What are the assets included in the statutory liquid assets? Can anybody give an answer? Some example at least. SRR. That SRR is called statutory reserve requirement. That is something different. This is in the banks. SRR in the sense, SRR means statutory reserve requirement. So banks and especially the banks, commercial the banks, when they are getting deposits, they have to maintain certain amount of the money with the central bank. That is called statutory reserve requirement. For example, currently statutory reserve requirement is, I think, 2%. If it is the 2%, if it is then if the commercial bank mobilize 100 rupee deposits, they have to maintain 2 rupee with the central bank. That is called statutory reserve requirement. But this statutory liquid asset is something different, which is when they are having the 100 million as a liability. If it is a commercial bank liability, if it is a specialized bank deposit, we have to consider as a consider the deposit amount. So we'll take an example of commercial bank. If they have the 100 million as a liability, their total liability is 100 million. They have to maintain 20 million as in the form of statutory liquid assets. So I am asking, what is the assets item can be considered as a statutory liquid assets? What is the basis for it? Actually, in the Banking Act itself, it's given a definition for a statutory liquid assets. And under the Banking Act, the Central Bank of Sri Lanka issued a direction, and in the direction they have defined, okay, you can consider these are the item as a statutory liquid assets. For example, cash in hand. Cash in hand can be considered as a statutory liquid assets. Then second one, the placement with other banks, which is also can be considered as a statutory liquid assets. Investment in treasury bills. Investment in treasury bonds. Discounted bills. Those are the items. They have defined, I think, Sri Lankan development bonds. They have defined nearly 10 to 15 asset item as a statutory liquid assets. So when they are having the deposit or liability, they have to maintain at least 20% of the liability in the form of this liquid assets, statutory liquid assets. So in the form of either cash in hand, either placement with other banks, either in treasury bill and treasury bond or investment, either in discounted bill form, or either in the Sri Lankan development bond form. So these are some of the examples for the statutory liquid asset. So when a bank mobilizes the deposit, 100 rupee deposit, first they have to maintain, if it is a commercial bank, when they are mobilizing 100 rupee deposit, they have to keep 2 rupee with the central bank, and then themselves has to keep with themselves the 20 rupees as a statutory liquid assets. So here, that is the ratio. First we are explaining that statutory liquid asset ratio is calculating statutory liquid assets divided by the liabilities. If it is a commercial bank's liabilities, if it is a specialized bank, we have to divide by the deposits and multiply by the 100. This is the way we are calculating statutory liquid asset ratio. Actually, mutual funds need not to maintain. That's a student asked about the mutual fund. Actually, mutual funds it's coming under the different regulatory framework. The mutual funds are not regulated by the central banks. The mutual funds are sort of investment type vehicles, which is regulated by the Securities and Exchange Commission, I think. So I think they don't have this. I'm not sure whether they are having any liquidity requirement, but this statutory liquidity, statutory liquid asset ratio is applicable for licensed banks. It may be licensed commercial banks or it may be licensed specialized bank. I think Mrs. Fernando would have explained you that what is a licensed specialized bank and commercial bank differences and all. Then the liquid assets to total assets, other ratio to compute the liquid asset liquidity condition or to ensure the liquidity conditions or liquidity position of the bank and finance companies, we are calculating other ratio called liquid assets to total asset ratio. So under this, what they are doing is they are liquid assets are divided by the total assets and multiply by 100. I think this is very straightforward ratio. Just whatever the liquid assets, they just divide by the total assets and multiply by the 100. And the current ratio, of course, this is it is not popular for a banks, but it is popular for a finance other companies, a production company, IT company, other companies. The current ratio. The current ratio you would have studied already, the A level and all. The current assets divide by the current liabilities and multiply by the 100. So that is the way they are calculating the current assets. Then liquidity coverage ratio. This is also under the Basel III. Under the Basel III, they are calculating this liquidity coverage ratio. I have already mentioned you all that there's a high quality capital can be called as a tier 1 capital. Likewise, there's a high quality liquid assets also. They are defining some very stringent policies. They define some high quality liquid assets, and high quality liquid assets are divided by the total net liquidity outflow for a 30 days and multiply by the 100. They are calculating this. Sorry, this equal sign is not appropriate. It should be multiplied. So it should be multiplied by the 100. So the whole idea is actually the bank has to forecast the net liquidity outflow for the next 30 days, and based on that next 30 days they have to maintain the high liquid assets. Normally it is the percentage, required percentage is 100% or more. So actually what they have to do is they have to maintain more than 100% of the high liquid asset, the liquidity coverage ratio. They have to maintain the 100% or more. In Sri Lanka, of course, the industry average is nearly 150 to 200%. They are having, these days they are having more high liquid asset ratio, this high liquidity coverage ratio. And net stable funding ratio is sort of long-term funding and liquidity ratio, which is available amount of stable funding divided by the required amount of stable funding and multiply by the 100. This ratio also they have to maintain, bank has to maintain more than 100%. So these two ratios, of course, under the Basel III Accord, these ratios has been introduced. So these are the ratios we are calculating for to identify any potential risk on liquidity. Any questions you all wanted to ask from me? Otherwise, I can move to the other section. Other one is investor ratio. Investor ratios normally when an existing investor or potential investor may keen on these ratios, or if you are a stock market investor, you may keen on these ratios, or when you are making investment in stock market, first you will calculate these ratios and make the decision. The first one is net assets per share ratio. I think in the balance sheet, in the bottom of the balance sheet, they always mention this net assets per share ratio. That will give an idea that, okay, what is the assets belongs to the, what is the value of assets belongs to this one per share. So it is based on this net assets per share, the share prices will increase or decline. So this is a good indicator to show the investor's value. So this is very simple calculation, net assets divided by the number of shares. Somebody may ask that how to calculate the net assets, the total assets minus the liabilities. So then we can calculate derive the net assets, which is the sort of equity value, though the amount attributable to shareholders. That is the net assets value, which is divided by the number of shares. And earning per share, of course, in the bottom of the balance sheet, they have normally the companies may mention the earning per share ratio. So per share, how much of the value they have earned for a particular year. So this is profit after tax divided by the number of shares. That is also very straightforward calculate. Just take the derive the profit after tax divided by the number of shares. For example, if a company has the this profit after tax of 100 million and their number of shares is 10 shares they are having, let's assume, then 10 million shares. If they have the 10 million shares, then the earning per share will be, earning per share will be 10 rupees. The 100 million profit after tax is 100 million and they are having 10 million shares, number of shares, then earning per share will be 10. And dividend cover ratios, this is as a time, this is not ratio, is the times profit after tax divided by the dividend per share. This is the way they are calculating dividend cover ratio. And dividend payout ratio, dividend paid divided by the profit after tax multiplied by the 100. So these are some of the investor ratios, which is these ratios are common for a bank and financial institution, even other companies as well, even a production company or trading company or IT company, these ratios are common. So these are the investor ratio. Any questions on these ratios? Then I'll just move to the I think these slides I have already explained to you all. The prudential ratios, the ratios that are used by financial institutions and regulatory authorities to monitor and to determine the stability of individual finance institution and financial system stability as a whole. Last week I have explained to you all that the regulators as well as financial institutions, they are calculating some ratios. Finances are, which is some ratios to monitor the stability of the individual financial institution as well as financial system as a whole. So generally they are calculating that those ratios are called as a prudential ratios. Generally they are calculating the prudential ratios with regard to the capital, with regard to the liquidity, asset quality, and risk management, as well as earnings also. So the capital, they are calculating capital adequacy ratio we have discussed, and tier 1, the leverage ratios and all. Liquidity, the statutory liquid asset ratio, liquidity coverage ratio, net stable funding ratio, those are the prudential ratios are calculated. And asset quality, of course, then NPL ratio and provision coverage ratio are calculated, and risk management, maximum amount of accommodations. So these are the some of the ratios are calculated by the financial institutions and regulators to ensure or to determine that whether the particular institution is stable and system as a whole is stable. So I just say that camel analysis: capital, liquidity, capital, asset quality, liquidity, management, and earnings. But now, of course, we don't calculate the management ratio. So capital, liquidity, earning, and asset quality, we can calculate it. So these are the prudential ratios the banks and finance companies are calculating. And the points for risk-focused business performance report, actually, the performance reports based on the risk-focused business performance reports are prepared and prepared by the regulators as well as the financial institutions. And at the time when they are preparing and variance analysis with short-term targets, budget, strategic plan, and KPIs and benchmark, they are calculating the variance. They are perform the variance analysis and identify the trends compared with the previous period. So, okay, when even the NPL ratio, ROE, ROA, or any other prudential ratio, they are identify the trends, how it's moving to the things. Currently in the industry, you can identify that currently in the industry, NPL ratios are increasing. So 2 years before, the NPL ratio of the industry was, the banking industry was just 3% level. But now it reached to 6% level. So they will analyze, the regulators and financial institutions will analyze the current trend. Okay, how the particular banks or the banking industries, these risk these ratios or indicators are moving. And check the compliance with the statutory and legal requirement. For example, statutory liquid asset ratio is one of the statutory requirement and legal requirement. So they will check these the ratios to ensure that whether the particular bank comply with the statutory requirement, and assess for new business opportunities and variable they can use it. Identify exposure to new type of risk, unfavorable market improvement or adverse changes, and finally extend to mitigate the address such address such risk. They are calculate. They are focused on this risk focused business performance report and these ratio calculations. The limitation in the ratio analysis. This is the, I think, the last section of this ratio analysis, or last slides of this ratio analysis. Even though we are calculating the ratio analysis using to compare with each period or compare with other institutions or take strategic decisions and all, there are limitations. The first limitation is historical information. The information used in ratio analysis derived from actual historical results, which is the main limitation for a ratio analysis. Actually, the ratio analysis is sort of post-mortem. Something happened, after something happened only, we are analyzing this ratio analysis. Another one is inflation. If the rate of inflation has changed, numbers are not comparable across the period. For example, some ratio analysis, we are saying that especially in the absolute value, the profit, we may say that, okay, in 1980s or 1990s, the profit is 100 million, but now profit is 120 million. Can we say that now we have improved? No, because the inflation, the value for 100 million in the 1990 is different from 2020, because now due to the inflation and value for money fallen. So if the rate of inflation has changed, we can't compare across the period. And operational changes. A company may change its underlying operational structure and compared to the same ratio today would yield the misleading the conclusion. If there are underlying operations, the banks from one business to other business, or company move from one business to other business, then there's an operational structural change. We can't compare the results. For example, if it is a production company moving to IT-based company, of course, we can compare the ratios. And accounting policies, different companies may have different policies for recording the same accounting transaction based on the accounting policies. And company strategy, it may not appropriate to conduct a ratio analysis comparison between two firms that are pursuing different strategies. And finally, it says that the same ratio extract information from balance sheet date as a date, particular date. It will show the particular date position. Actually, the ratio analysis will not show during the year what happened. Actually, for example, liquid asset ratio, they are calculating based on the particular date. It won't show that, okay, during the month, what will happen to the bank's liquid assets. Sometimes bank may keep very low liquid assets during the month, but at the end of the month, they may maintain the minimum requirements. So it's showing only the point in time. So these are the limitation in the ratio analysis. Any questions? Any questions you all wanted to ask from ratio analysis? Otherwise, we can move to the other area, the other sections. I think the first section of the last class sections have been completed now. That ratio analysis and financial reporting and ratio analysis. Now we are going to move to the next area, the next topic, which is about the internal and external audit. Actually, if you see the exam paper, there's a 20 marks questions related to the financial reporting and internal audit. So sometimes they are just giving focus on the financial reporting and ratio analysis section. Sometimes they are entirely focused on in external and internal audit section, or sometimes they just mix the external audit, some audit questions and some financial reporting questions in the exam papers. But anyhow, I think question number 3 is related to the financial reporting and internal and external audit section. So you can, if you are clear in these 2 sections, you can earn, you can get 20 marks. Okay. If you all have any questions, otherwise I'll just move to the some sample questions. Actually, I have here in next 3 slides having some sample questions. Whether you would like to discuss today, or you all wanted some time to go through these questions and be prepared for the questions, and then the next class discuss the answers. What is the way you all want? You all wanted to discuss now, or you all, shall we do in this way? We will just because after this class they will upload this presentation. Then what you can do is you can ready with the these questions, answer for these questions, and the next class we can discuss. Then you also, otherwise what will happen is I'll just tell the answer, you all may not ready for the answers, even though you have studied in the last class and today's class. Or you will prefer to discuss today itself and finish it off. Come on, students. I like to hear your views. What shall we do? Shall we discuss this question in the next class? So you will have the time to go through the questions, and then you all can. What you all can do is you all can discuss. Yeah, yeah. There are two responses, three responses. They are saying that we'll discuss in next class. That's a good idea. Actually, I also expected that then you guys can go through and even from the notes and all, you can go through the and be ready with the answers. Then when I am saying the answers, you all can just compare whether your answers are matching with my answers. So I think in the next three slides, slides number 13 and 14, 15, I have given some sample questions. So please go through those questions and be ready with the answers in the next class. Then we will discuss that these questions in the next class as well. Okay. Having that note, I just move into the new topic, which is internal and external audit. I think the financial reporting section, this internal and external audit is most relevant. And if the finance department people, and in this topic, I like to cover this external and internal audit and regulatory requirement and audit and Sri Lankan auditing standard in very brief manner, and audit process, audit types, audit risk, and role of audit committee, and reporting and resolving audit issues and concerns. So these are the topics I will discuss in this particular area, the internal and external audit. So first, because when we are starting some new area, even that is maybe risk management, that may be compliance function, or that may be financial reporting, even now audit. What is the first question we have to learn? What is that? Or what is liquidity? Oh, sorry, what is the risk management? What is compliance function? What is financial reporting? Now we are going to discuss. First thing we are seeing that what is an audit? What is the definition for an audit? Audit is a systematic and independent examination of books, accounts, statutory records, documents, and vouchers of the entity to ascertain how far the financial information as well as non-financial information of an entity present a true and fair view, acceptable and reliable. So here, some of the words we have to keep it in mind. The audit is a systematic and independent examination. That is the first word you have to keep in mind. The audit function is sort of independent examination, independent functions, which give a independent assurance to the management or shareholders that the accounts are free from any material misinterpretations. So in the audit, first we have to keep in mind it should be an independent examination of books. Of course, I need not explain you. Accounts. So when the finance people prepare the accounts, these people first check the books and account, statutory records. What is the statutory records? Any government department or statutory related records, receipts, or some other certificates. So statutory records and documents, vouchers of an entity to ascertain how far the financial information as well as non-financial information. Because some people are misleading that these audit people are always looking to the financial information. Actually, this is the financial information as well as non-financial information of an entity present a true and fair view, acceptable and reliable. Sometimes the non-financial information may be very important information for an entity. For example, sometimes before the government brings a new legislation, okay, some limitation to produce a lunch sheet or shopping bag, the cellulite bags. So if the industry, the companies in that industry, even though it is not a financial information, it is a non-financial information, but which is an important, which will affect their profitability. Sometimes it may affect their going concern. So when the auditors examine the books, accounts, statutory accounts, and things, how far the financial information, they have to consider non-financial information of the entity as well. And second bullet point says that it also attempts to ensure that books of accounts are properly maintained by the entity. Okay, even though it is the accounts are given the true and fair view, actually the books of accounts are should be properly maintained. Without properly maintained, there may be several ways to prepare the accounts. So the audit also ensure that books and accounts are properly maintained by the entity. Other one is auditing is a safeguard measure. It provides a third-party assurance to various stakeholders that the financial statements, any other area subjected to audit is free from material misstatements. Actually, the auditors are giving a third-party assurance or independent assurance to various stakeholders of the company. For a bank, it may be the shareholders. It may be a depositors. It may be a lenders. It may be a regulators. To various stakeholders, it provides the third-party assurance or independent assurance. The financial statements are free from material misstatements. So like the financial reporting, auditing also considering the various stakeholders, the audit reports are provided to various stakeholders. The various stakeholders are expecting the audit reports for their purposes. And the audit term is mostly applied to financial information of an entity. In addition, other areas subject to audit in a financial institution include compliance, internal controls, and risk management. Normally, the audit function is, audit is mostly applied to the financial information, so the accounts and payments and all. But still, the audits are carried out for the compliance function audit, internal controls, whether internal controls are properly implemented, and risk management, etc. also covered under the audit. Main type of audits are include internal and external audit. There are two type of audits. One is internal audit, other one is external audit. Internal audit, everybody knows that within the institution, there's a separate independent people. Even though they are employee of the institution, the separate independent people carry out the internal audit and report to the management. Sometimes in a bank or the larger institutions, they may assign internal audit function also external people. But generally, there's a separate division called internal audit department. That internal audit department will carry out the internal audit function of the banks and finance institutions. Other one is external audit. The external audit, of course, the independent people appointed by the shareholders in an annual general meeting, examine the books and accounts, statutory records and everything, and giving an independent assurance to the shareholders that the accounts are free from material misinterpretation, misstatements, and it gives true and fair view. So there are two types of audit. First one is internal audit, other one is external audit. Any questions? Yes, students, any questions? Okay. In the previous slides, I have discussed you, or I have told you, there are two types of audit. First one is internal audit and second one is external audit. Here, of course, we are going to discuss what are the differences between internal audit and external audit. Sometimes there may be questions in the exams. Compare the internal and external audit. There may be short notes. Then you may have to give the differences between the internal audit and external audit. The first one is internal auditors can be employed by the business or outsourced. That's what I have already mentioned. The internal auditors may be business employees, that employees of the entities, or it can be outsourced. But external auditors are appointed by the shareholders' vote. In an annual general meeting, this may be one of the agenda item. They are appointing the external auditors. So based on the resolution passed at the annual general meeting, the shareholders, based on the shareholders' vote, they appoint the external auditors. And the second one is internal auditors are responsible to management, but external auditors are responsible to shareholders. That is the main difference you have to mention. If there is any difference, if there is any comparison between internal audit and external audit, you have to mention that internal audit are responsible to the management. It may be board of directors, but the external auditors are responsible to shareholders. They are reporting to the shareholders. They are submitting reports to the shareholders, not to the management. But internal auditors, they are responsible to management. First, they are just checking and reporting to the management in different management structure. Even though the accounting background for internal audit is common, they can also come from other backgrounds as well. But the thing is, it's generally an internal audit, accounting background people are carrying out, but it can be there may be other background also covered. But should be qualified auditor for a specific business enterprise in Sri Lanka. It is one of the statutory requirements. If it is a specified business enterprise in Sri Lanka, it should be a qualified auditor can carry out the external audit function. And other one is, the fourth one is internal auditors provide advice and other consultancy assistance to management, and they examine the issues related to company business practices, risk, etc. But external auditors examine the financial records and issue an audit opinion on the financial statement of the entity. Actually, The internal auditors provide the advice and other consultancy assistance to the management on the issues related to the business practices, internal controls, and etc. But actually, the external auditors are not exactly. They don't want to give the advice. What they are doing is they examine the financial record and giving the issue the audit opinion on the finance statement of the entity. That is their job. Different mandates. Actually, when you are seeing that there's a different mandate between internal audit and external audit. External auditors, the mandate is giving or examining the books and accounts and giving the audit opinion on that finance statement. But internal auditors are mostly to provide advice and other consultancy assistance. Internal audit agenda is set internally in the light of business risk and objective, but external audit program of work based on its assessment of the risk of the accounts being material misstated. Internal auditors can issue their findings in any type of report format, but external auditors must be use specific format for their audit opinion and management letters. I think here we have mentioned this is one of the external auditors report. There's a format. Actually, they have to adhere to that particular format. But internal auditors, of course, it is depend on the bank to bank or finance company, the company to company. It depends. They can follow whatever the formatting, but external auditors must use a specific format. Internal audit reports are used by the management. External reports are used by stakeholders such as investors, creditors, lenders, etc., even depositors. Internal audit are conducted throughout the year. External audit conduct a single annual audit. They are conducting annual audit. So actually, this is nothing much to explain you all that. This is very straightforward differences between the internal audit and external audit. You can just read it and understand. There's nothing rocket science here. So I think you all can understand. If you all have any questions, you all can ask from me. Other one is regulatory recommended audits of banks. The requirement under Banking Act for external auditors of banks. Actually, the Central Bank of Sri Lanka as the regulators issue the direction on the audit requirement of the banks. And based on that, the central bank prescribed that, okay, they have time to time, they publish the qualified auditors who can audit a bank accounts. Like other companies, any auditors cannot audit the bank accounts. The Central Bank of Sri Lanka published the name list of the names. Okay, these are the auditors can audit a bank and submit the reports. So that is one of the requirement. Bank has to comply. And the audit reports and time frame for that audit report also prescribed by the central bank. Central bank says, okay, within this time frame, you have to submit the audit report. Audited accounts within 5 months. Yes, within 5 month period, annual audited report has to be submitted by the banks. So this is one of the requirement. A requirement under the CBSL direction on corporate governance for external auditors and audit committees. Actually, the regulatory requirement, that is other one of the requirement under the corporate governance. The next section we will study on the corporate governance. Under the corporate governance, central bank issued the direction, and based on that, there should be a audit committee. And the audit committee also, there are different requirements under that particular guidelines or direction. there should be independent. These people are independent directors, reporting line, and the chief auditors roles and responsibilities and everything has been required. And generally, other than these two, other CBSL direction and guideline on internal and external audit of the banks are issued. Guideline to external auditors, outsourcing an audit activity, mandatory internal audit requirement. Actually, one of the guideline of the central bank, the bank supervision department issued a guideline saying that there should be a separate department in a division in every bank for an internal audit department, and that internal audit is responsible for giving assurance on the internal control system, and they must have the separate independent reporting lines and all. So these regulatory requirements and audit of the bank are mentioned. Other than that, Sri Lankan auditing standards, of course, issued in terms of Sri Lankan Accounting and Auditing Standard Act number 15 of 1995 by the Institute of Chartered Accountants, issued this These auditing standards are time to time released by the Institute of Chartered Accountants of Sri Lanka, and it is issued based on the international standards on audit published by the International Auditing and Assurance Standard Boards, like accounting standard. This Chartered Institute issued the auditing standard based on the international auditing standard published by this international IAS, the International Accounting Auditing and Assurance Standard Board. And Sri Lanka, it says that one of the requirements is financial statements of the specified business enterprises in Sri Lanka shall be audited by professionally qualified auditor. So these are the one of the requirement it's mentioned here. And the next one is Sri Lankan auditing standard can be classified under the following area: respective responsibility, audit planning, internal control, audit evidence, using work of other experts, audit conclusions and audit report, specialization. We will discuss these things subsequently. So these are the things related to the Sri Lankan auditing standards. And major categories of the independent auditor's opinion. Actually, the external auditors, the major mandate of the external auditors is checking the books and giving the audit opinions. And the audit opinion, there may be a format, and they can't give audit opinion like whatever they want. Actually, there's a set of formats. There's a certain opinion only they can give. First one, mainly we can classify or can segregate the audit opinion into two. First is unqualified opinion. Other one is modified audit opinion. The unqualified opinion means everything is perfect like that. It is the best possible audit outcome and most frequent opinion. Assures the public that the auditor has examined the financial statement and it is of the opinion that financial statements are presented fairly in conformance with the applicable accounting standards. This is the actually unqualified audit opinions are sort of the best audit opinions or the best available audit opinions. Or otherwise, if there are some issues on the accounts and books, then the auditors will have a choice of giving the modified audit opinions. Modified audit opinion, of course, there are three types of modified audit opinions. One is qualified opinion, other one is adverse opinion, other one is disclaimer from opinion, from opinion. The qualified opinion is emphasis of the matter paragraph or other matter paragraphs. So they say that, okay, they just emphasize on the particular paragraph and the meta paragraph and giving the audit opinion. The adverse opinion, of course, audited financial statement do not fairly represent the entity's financial position performance. And there are significant departures from applicable accounting standard. Adverse opinion. When an auditor issues an adverse opinion, the report will specifically state the reason for the opinion. When they are giving, actually, there is nothing too much to explain. These are some standard formats, and I just telling that when they are giving that adverse opinion, they can issue an adverse opinion. Report will specifically state the reason for opinion. Adverse opinion will result in the rejection of the entity's financial statement by investors, lending institutions, regulatory bodies, and governance. So this is the second type of modified audit opinion. And third one is disclaimer from opinion. They refuse to give an opinion. The auditor has chosen not to issue an opinion. So first one is unqualified opinion. Unqualified opinion is sort of the best available opinion. Second one is by emphasizing a particular matter, they say and giving the opinion. For example, except to this matter, all other things are fine. For example, they in a bank, they purchase. For example, there's a bank and one of the customer or counterparty filed the case, and that case is the bank is weak in that case, and sometimes bank may lose that case. And if the bank lose that case, they may incur more losses, or sometime it may affect the bank significantly. So in that scenario, what the auditors can do is the qualified opinion. They say they emphasize to that matter. Just okay, this matter, emphasize to this matter. Okay, the bank has seen this problem, but the emphasize, but other than that, okay, the bank accounts are giving the true and fair view. The emphasis of matter of paragraph. Okay, accept that paragraph. An adverse opinion, of course, they directly say that audited financial statement do not fairly represent the entity's financial position. They just adversely giving the opinion. It doesn't show that the accounts is different from their financial accounts and all. This is the worst available option, the adverse opinion. And the disclaimer from the opinion, in the sense, auditors choose the option that not to give any opinion on the accounts, the disclaimer from the opinion. So these are the majority of the category of the opinion the auditors can give to the on particular financial statements after the auditing. Any doubt or any questions you're having? Actually, please go through, take a bank's annual report and go through their audit opinion. Actually, it is better for the last class and this class. What you all can do is you all can take an annual report of a bank. If you all work in the bank or finance company, it is better to go through your bank account. So otherwise, it is available in the CSE website, Colombo Stock Exchange website. You just select one of the bank's shares, and then in that the site, and in that site, there will be a financial statement where you can download the annual report. It is better actually for the students. I can advise you all that it is always better to read at least one annual report. There are lot of information about it. There are a lot of these. Even you can get some idea about the ratio analysis and some risk management reports, even auditors' opinions, how the auditors' opinions are formatted. Everything is available in an annual report. So better if you'll read 2-3 annual reports and compare bank to bank, that is fine. That is always best. But even at least go through one audited accounts annual report and just go through, okay, what are the sections included in the annual report? Chairman report, chairman view message, CEO's message, and risk management reports, audit reports, and finance statement, ratio analysis. There may be several things. Okay, just go through. That may be good for you. And in the contents of external audit report, this is actually this is a sample of the reports. In the report, this is I think ENY report given for finance leasing of PLC. So normally, generally, in a finance in an audit report, there may be a title, an addressee, an introductory paragraph, identification of finance statements audited, and respective responsibility of the management and the auditor. It is included here. Actually, these are the scope paragraph and reference to relevant accounting and standard of practices. Description of work and audit performed. Opinion paragraph containing an opinion of finance statement. Auditor's signatures, date of the report, and auditor's address. So these are the things, auditor's address. These are the things included in an external audit reports. You can just look at these things and check whether this audited in your annual audit reports, whether those are the sections available or not. You can just compare and get an idea. And audit progress and external audit, of course, like financial statement progress, we see that how the financial statements reporting process are happening. Here also, this audit engagement, first they will appoint the audit engagement and then planning the audit and test the controls and substantive progress and completion and reporting. So this is the way the audit progress and external or often external audit. First, the audit engagement will happen and then audit plan, then test of the control and substantive procedures and completion, and then finally they will report. So this circle will continuously happen. An audit process of the internal audit, of course. Actually, there are 4 types of process involved in the internal audit: planning, assessment, reporting, and follow-up. Because it's a continuous process. First, for every year, they plan, okay, what would be the for this year, because they won't check the entire institution. They may check 1 or 2 area in the institution. So they may plan and then, okay, this year, these are the areas we are going to cover. They will plan and then they will do the assessment and they will check the internal audit, do the internal audit assessment checking. And then they will report to the top management and then they will follow up whether their recommendations are follow up. So under the planning, the internal control questionnaire and audit scope objectives are get involved, and the assessment, field work, evaluation and testing get involved, and in the reporting, communication, audit finding, assessment and risk are coming, and confirmation, plan actions and audit verifications. Then actually audit type and audit risk. There are several type of audits available: financial statement audit, information statement audit, compliance audit, follow-up audits, and operational audit. There are several type of audits are available in the things. This is I think nothing too much explain to you all that this the audit type. This is mainly theories. Just you can just read it and understand the things. Then I just move into the role of audit committee. I said that there are audit committee in the banks. Actually, in a bank, it has to appoint an audit committee. That audit committee is responsible for audit function of the bank. Generally, the first thing is we have mentioned the composition of the audit committee. The chairman of the audit committee shall be an independent, non-executive director. Here, of course, in the corporate governance, we will see that who is the independent director, who is the non-executive director. It says the chairman of the audit committee shall be independent, non-executive director with qualification and experience in accountancy and audit. So actually, at that time, we will discuss in this. So how to get the in the audit composition, they have in the board of directors, they have to have different qualified and experienced people. So they have to, from that, they have to find a accountancy and audit experience and qualification person, and he must be an independent and non-executive director. So they can appoint such a director as a audit committee chairman. And all members of the audit committee shall be non-executive directors. I will explain at the corporate governance section why it should be a non-executive director. Why can't be the executive director? At that time we can study. And audit committee shall, in respect of external audit, the audit committee has some responsibility with respect to external audit function. The first one is make recommendation on appointment of external auditor, service period, audit fee, resignation or dismissal of the auditor. They implement central bank guideline issued to auditors, review and monitor the external auditors' independence, objectivity, effectiveness of audit progress in accordance with the applicable standard and best practices, develop and implement a policy on the engagement of the external auditor to provide non-audit service that are permitted under the relevant statutes. Before the audit comments, discuss and finalize with the external auditor the nature and scope of the audit, and review the financial information in order to monitor integrity of the finances. This is just, you can read it and understand it. I think nothing too much to explain these things. And this is again this slide mentioning about the role of the audit committee. The audit committee shall, in respect of internal audit function, what are the roles and responsibilities related to that. I think you guys can just you can just understand it. And then the other slide is the role of the audit committee. The audit committee meetings, it says that the audit committee meetings and authority and resources of the audit committee and whistleblowing. The audit committee shall meet regularly with due notice of issue to be discussed and shall record its conclusion. Chief Finance Officer, Chief Internal Auditor, and a representative from the external auditors may normally attend the audit committee meeting. Like this is just you can just read it and understand this. This is nothing too much about to explain. This is some clauses are mentioned here of the audit functions. You can, if you have any questions, you can ask. Otherwise, I just closing this today's class. And the next class, of course, I will discuss about the questions related to the financial reporting and I will start sometimes corporate governance, or mostly I will discuss the questions related to the financial reporting as well as internal and external audit. At that time, we can go through some of these things if you want. Otherwise, it's again just read it and get understanding. Nothing too much explained in this audit section because this is mostly the theoretical part. If you all have any questions, I can just answer. Otherwise, I will wind up the class today. Okay. We'll meet tomorrow, the next class.